What if I told you that the single biggest legal question hanging over the entire crypto industry, the one that has cost investors billions in uncertainty, triggered lawsuits, crashed projects, and kept institutions on the sidelines for years, was just answered? On March 17, 2026, the SEC and CFTC did something nobody thought was possible. They actually agreed on something. They issued a joint 68-page ruling that officially classifies 16 major cryptocurrencies, including Bitcoin and Ethereum, as digital commodities. Not securities, commodities. And if you don't understand why that distinction matters, stick around. Because this changes everything about how crypto is regulated, taxed, and traded in the United States. And there's a twist at the end that nobody saw coming. You're listening to Converts, your guide to currency, crypto, and conversions. I'm here to break down what this ruling actually means for your portfolio, why the market reacted in the exact opposite way you'd expect, and what comes next. Let's start with the basics. Why does it matter whether crypto is a commodity or a security? Here's the simple version. If something is classified as a security, it falls under the SEC. That means strict registration requirements, disclosure rules, and the kind of regulatory burden that makes it nearly impossible for most crypto projects to operate in the US. Think of how stocks work. That level of oversight. But if something is a commodity, it falls under the CFTC. And the CFTC takes a much lighter touch. They focus on preventing fraud and manipulation in the markets, but they don't require the same mountain of paperwork. They don't demand that every token register like a stock offering. For years, and I mean years, the crypto industry has been begging for clarity on this. Which tokens are securities? Which ones are commodities? Nobody knew. And that uncertainty was poison. It scared away institutional money. Big firms like BlackRock, Fidelity, Goldman Sachs, they were interested in crypto, but their compliance departments kept saying no. Too much legal risk. It made exchanges delist tokens just to avoid potential lawsuits. Projects moved overseas. Developers left the country. The US was losing the crypto innovation race to Singapore, Dubai, and the EU. All because Washington couldn't get its act together. Well, that gray area just got a whole lot smaller. The joint ruling introduces something called the Token Taxonomy Framework. It breaks digital assets into 5 distinct categories with clear definitions for each one. This is the first time US regulators have created a structured classification system for crypto. Before this, it was basically vibes and lawsuits. And the 16 assets that made the cut? We're talking about the biggest names in crypto: Bitcoin, Ethereum, Solana, XRP, Cardano, Chainlink, Avalanche, and 9 others. You can find the full list of all 16 named digital commodities in the blog post on converts.app. I'll spare you the full rundown here, but just know, these are not small projects. Together, these 16 assets represent well over $1 trillion in market cap. Now here's where it gets really interesting for people who actually use these networks. The ruling explicitly states that staking, locking up your tokens to help validate transactions on proof-of-stake networks, is not a securities transaction. This is huge. The previous SEC chair, Gary Gensler, had basically declared war on staking. His SEC went after major exchanges for offering staking services, arguing it was essentially an unregistered securities offering. Billions of dollars in staking services were pulled from US customers because of that interpretation. That's done now. The new ruling says staking is a fundamental network maintenance activity, not an investment contract. Same goes for mining rewards and airdrops. If you're earning tokens through participating in network operations, that's not a securities transaction either. Think about what this means. Ethereum validators can breathe easy. Solana stackers don't have to worry. Exchanges can offer staking services to US customers again without the threat of an SEC enforcement action hanging over their heads. And for everyday people, if you've been staking your Ethereum or your Solana and wondering if you're accidentally breaking some securities law, you're not. The US government just told you in writing that what you're doing is fine. That peace of mind, it's worth a lot. This is a complete 180-degree turn from where we were just 2 years ago. And speaking of that 180, Let's talk about how we got here, because the contrast is striking. Under Gary Gensler, who chaired the SEC from 2021 to early 2025, the approach was regulation by enforcement. There was no framework, no taxonomy, no clear rules. Instead, the SEC would just sue projects after the fact and let the courts figure it out. Gensler famously said that everything except Bitcoin was potentially a security. Everything. He went after Coinbase, Kraken, Ripple, the list goes on. The current SEC chair, Paul Atkins, took a fundamentally different approach. Instead of suing first and asking questions later, his SEC actually sat down with the CFTC to create a real framework. They took public comments. They consulted with industry. And the result is this 68-page document that, love it or hate it, actually gives the industry something it never had before: clarity. Now, I mentioned there was a twist. And this is the part that's going to blow your mind. You would think that the single most positive regulatory development in crypto history, the thing the industry has been begging for since basically forever, would send prices to the moon, right? Bitcoin should be at $100,000. Champagne corks popping everywhere. Instead, Bitcoin dropped. On the same day as this historic ruling, Bitcoin fell to around $70,538, down from over $83,000 just weeks before. Let that sink in. The most pro-crypto regulatory announcement in American history, and the market sold off. What? Here's what happened. The Federal Reserve held its policy meeting that same week and kept interest rates unchanged with a distinctly hawkish tone. Fed Chair Powell signaled that rate cuts were not coming anytime soon. And in financial markets, monetary policy beats regulatory clarity every single time. Think about it this way. You can have the best regulatory framework in the world, but if money is expensive to borrow and there's no fresh liquidity flowing into risk assets, prices still go down. The macro environment trumped the micro catalyst. This is actually a really important lesson for crypto investors. Regulation matters, but it's not the only thing that moves markets. You have to watch the federal. You have to watch interest rates. You have to understand that crypto doesn't exist in a vacuum. It's connected to the broader financial system. If you want to track how these 16 newly classified digital commodities are performing in real time, Converts.app has live price data for all of them. It's one of the easiest ways to keep an eye on the market without all the noise. But here's the thing. This ruling might be just the beginning. There's a bill moving through Congress right now called the Clarity Act. It would codify this commodity classification into actual law, not just a regulatory interpretation that could theoretically be reversed by a future administration. And based on current prediction markets, the Clarity Act has about a 72% chance of passing. If it does pass, we're looking at a completely new era for crypto in America. Institutional investors who have been sitting on the sidelines, pension funds, endowments, insurance companies, they've been waiting for exactly this kind of legal certainty before committing serious capital. A law on the books is a lot harder to reverse than a regulatory ruling. And there's a downstream effect that's easy to miss. If these 16 assets are commodities, then the exchanges that list them don't need to register as securities exchanges. That's a massive compliance burden lifted. It means more competition, better products, and potentially lower fees for everyone. But let me be real with you. There are critics. Some consumer advocacy groups argue that lighter CFTC oversight means less investor protection. They point out that commodity markets don't have the same disclosure requirements as securities markets. If a crypto project is classified as a commodity, they don't have to file quarterly reports or disclose insider transactions the way a publicly traded company does. That's a fair concern, and it's something to watch as this framework matures. There are also thousands of tokens that were not named in this ruling. What about them? The framework creates categories, but the actual classification of individual tokens beyond these 16 is still ongoing. So if you're holding a smaller altcoin, the uncertainty isn't completely gone. Not yet. And here's something else to consider. Just because an asset is classified as a commodity doesn't mean it's a good investment. Commodities can still crash. They can still go to zero. This ruling is about legal classification, not about whether these tokens are going to make you money. Don't confuse regulatory approval with investment advice. They are very different things. Still, the direction of travel is unmistakable. The U.S. government has gone from treating crypto as a suspicious, possibly illegal activity to creating a structured classification system that treats major digital assets the same way it treats gold, oil, and wheat. That is a seismic shift. And for the 16 assets that made this list, the legal cloud has lifted. Exchanges can list them with confidence. Institutions can invest in them without their legal departments having a meltdown. Developers can build on these networks without worrying that the SEC is going to show up with a lawsuit. Now, the short-term price action might not reflect this because, well, the federal. But long-term, having regulatory clarity is the foundation that everything else gets built on. Products, services, investment vehicles, retirement accounts. None of that happens without knowing the rules. So what should you actually do with this information? If you're already in crypto, this is validation. The assets you hold just got a legal stamp of legitimacy from the two most powerful financial regulators in the country. That doesn't mean sell. That doesn't mean buy more. It means the ground under your feet just got a lot more solid. If you've been on the fence about crypto, the biggest barrier to entry just got removed. The legal uncertainty that kept a lot of smart, cautious people away is now gone for these 16 assets. The on-ramp just got wider. And for everyone, keep your eyes on two things. First, the Clarity Act and whether it passes. That would be the cherry on top of this ruling. And second, the Federal Reserve. Because when rate cuts eventually come, and they will eventually come, you're going to see what happens when regulatory clarity meets fresh liquidity. And you can track all of it, all 16 classified assets and more, at converts.app. That's it for today's episode. For the full article with all the details, head to converts.app. And if you found this helpful, subscribe wherever you're listening. Until next time.